All right, welcome everybody. Thank you for being with us here today. For many of you, welcome back. I know last month when we had one of these sessions of the Advisor Advancement Mastermind series, which was all about introductions, a lot of you are joining us again today as we get into the success blueprint for AUM growth. So we're really excited. I just wanted to start out by thanking you for taking the time away from your day. I know some of you are joining us over your lunch hour. Those of you in other parts of the country are taking time away from the day. But either way, thank you so much for spending the 45 minutes with us. And our goal is to pack as much value into the next 45 minutes as we can. So I'm going to go ahead and jump right in. We've got a lot to cover today. We do have a full house of advisors that are in attendance. So really excited about that and a lot to talk about. A couple housekeeping items. You'll notice at the bottom of your screen, you see a chat icon, and that is a Q&A icon. Might look like a little chat window. If you go ahead and click on that throughout the course of the session today, you'll be able to submit questions to us. Can't guarantee that we'll be able to get to those live, but do please know if we can, we will as time permits. But if we're not able to get to them live, we will be following up with you individually after the event. So know that we will be reviewing all of those and getting back to you. Also, just want to encourage you all, please be sure to stay until the end. We are looking to run about 45 minutes, and we do have two giveaways, two freebies that we're going to be talking about today. So stick around till the end so we can talk about how we can get those into your hands. But without further ado, I'd like to go ahead and introduce our speakers for today's session. First, Mr. Kevin Roskam. Kevin is our senior advisory business consultant here at USA Financial. To make it simple, Kevin has been around since $1 of AUM and has been a huge part of the development and growth of the assets under management and advisor development for the last 15 years. And then alongside Kevin is our fearless leader, our CEO, Mike Walters. And Mike has been around for much longer than 15 years, since day one in 1988. So without further ado, I'm going to turn it over to Mike and Kevin. We've got a lot to cover, really excited. So Mike, I'll let you take it away.
Thanks, Matt. Warren Buffett has one of my favorite quotes, only when the tide goes out do you discover who's been swimming naked. And with the pandemic in the year 2020, we've really seen a lot of nakedness in the financial advisory business. Advisors who have been flying high on commissionable and transactional revenue kind of came crashing down with the lockdowns that have taken place, when their business model was entirely built upon face-to-face interaction, live events, people in and out of their office, really the things that we all do as financial advisors, but most specifically, the direct tie to those types of interactions to commissionable and transactional business. The fact that you're only as good as your last transaction, if you will. That business got hit really, really hard. And what saved and even allowed many advisors to grow during the pandemic has been their asset under management business, their recurring revenue business, their fee business. And that's really what we want to focus on for you here today. Now, our organization is made up of 7 different subsidiaries. You see them on the screen here. And what you'll notice is in the lower left, USA Financial Insurance Services is actually an IMO and an FMO and is specifically focused on that transactional business. So we do, in fact, embrace the annuity sale and various other commissionable type sales, but we know that there's much more than just that. And as you'll see across the top here, our 3 organizations, Securities, Formulas, and Exchange, they're all there to support you in developing your business from a fee and a recurring revenue standpoint. USA Financial Securities is duly registered as a broker-dealer as well as a corporate RIA. So whether you're an IAR or an RR, it's allowed, it's there and available for you to have those support mechanisms in place. Formulas is actually an asset manager created on a specific concept of formulaic trending and how that fits very specifically into the equity markets. And then finally on the right, which we'll spend a fair amount of time on today, is USA Financial Exchange, which is our turnkey asset management program, what people often refer to as a TAMP program. This allows not only our own asset manager, but many other asset managers to operate on exchange and gain access to you, the retail advisor, so that you now have a seamless tool to use to interact with the investor in a single account with multiple asset managers at your fingertips, multiple models at your fingertips. And Kevin's going to dive deep on this as we go through today. Then at the bottom, you'll notice 3 other organizations: marketing, HQ, and protocol. So whether it's us helping you run your websites, handle your social media footprint, fill live seminar events when the timing for that sort of thing is ripe again, running digital recruiting and events, I should say client events. This is a digital version, if you will, of what we're doing for you today. We're doing these same sorts of things for consumers, for investors, to raise business for financial advisors. And then HQ is our fintech firm, along with Protocol being our practice management and our coaching and mentoring firm. All of these things blend together to really help you grow the enterprise value of your practice. And that's what our sweet spot is. That's what our wheelhouse is all about. We believe in aggressively growing and protecting an advisory practice. And during 2020, that became really evident. In fact, on this particular chart, what you're seeing is the top 40 individual advisors. So these are not offices, these are individual advisors, ranked by their 2020 revenues that they received as revenue and income through their production, through their client base, and so on. But what I really want to draw your attention to is look at the green column for 2020. That's the growth column by revenue to advisors for the year 2020. And if you go all the way to the bottom, what you'll notice is that group in green, it grew by better than 5% on average during the pandemic year of 2020. I don't think there's another organization in the country that has a collection of advisors that actually grew like that during the pandemic. In fact, most have the opposite story to tell. They have a situation where you've been losing money as an advisor due to the lack of that transactional revenue that we talked about. And then if you look at the blue column on the far right there, the 3-year growth rate for that particular group of advisors, you're looking at about 185%. And what I think is most important about that, other than the shocking number of 185, is that 185% includes 2020. So imagine if 2020 had been a normal year, what kind of numeric you would see in that third blue column. Again, this is kind of the sweet spot and the focus of what USA Financial is all about. We help advisors get to that elite status. We help them aggressively grow, but at the same time, continuing to protect their practice. So let's take a look at 2020 itself and what was so different here. Well, we know that client interactions have changed, and they've likely changed forever, but in many ways, it's also been for the good. And it's advisors who have embraced this as an opportunity that have actually grown during 2020. So for example, historically, we've always had challenges with like snowbird clients or clients moving away or dealing with the adult children because they're long distance and we don't have that interaction. And yet now we're able to have advisors communicate with clients very comfortably through digital video, just like we're doing here through a Zoom call or whatever mechanism you prefer. They have gotten comfortable with that. So during the pandemic, people age 60, 70, 80 and above, they wanted to stay in touch with the grandkids. And we've had this learning curve that probably would have taken us decades to get to. We got there in 2020 because now they're all comfortable dealing with these sorts of things. So the question then became, how do you embrace that in running your practice? It obviously helps in the future with things like that snowbird. But at the same time, if you were running live events, if you're doing all these things, you had to have some conversion there. And then the underlying issue in addition to that is embracing the new technology that's required. A lot of people kind of batten down the hatches. They weren't focusing on growing their practice appropriately. And they weren't servicing the clients necessarily the way they should. Clients want you to be economically invested and engaged in the relationship. So if you were just selling commissionable products and then you disappeared during the pandemic, you likely lost a lot of relationships and a lot of opportunity. But if you were focused on assets under management and continued to work with these people during this period of time, you had an opportunity for growth. And when we design and dissect down into that, on this next particular slide, you'll see what relates to where we saw some commonality. So in 2020, what we found was that 95% of advisors who had an increase in 2020, in that green column you're seeing there, they had at least 50% or more of their revenue represented by assets under management. So they had a stable base built into their advisory practice that they could continue to work from and grow on. They weren't just dependent on the next transaction. But the flip side of that, unfortunately, is also true. What we found is that 87% of advisors who experienced decline during 2020, they had less than 25% of their revenue coming from assets under management, meaning they had 75% or more of their revenue coming from transactional or commissionable based things. Now, again, we embrace both those, and we're going to talk about that later as we continue on. But the key is you have to have proper blend. You have to have proper balance in order to truly be successful, especially during difficult times like we've experienced during the pandemic, and then turn that into an actual growth opportunity.
And so that's where I come in. And as I go through my part, I've asked Mike to chime in and be there with me just because I will lose track of time and get excited about this. And so the successful blueprint for AUM, before we even talk about a blueprint, we kind of have to set the stage. There's decisions that you need to make before you can start down this path. And there's three main questions that we've got to talk about. The first question that you've got to ask yourself is, am I an asset gatherer or am I an asset manager? And there is really a distinct difference. An asset manager, someone who wants to manage assets, for a lot of us, that's what we think of when we think of getting into the AUM world. And it's why we don't. It's why we don't want to be overly involved in securities, because we don't want to manage the assets. But an asset manager, of course, is focused on the ups and downs of the market and the ups and downs of what they're invested in. And sometimes that hurts the client relationship, because these client relationships, the clients are expecting you to perform. They're expecting the money you manage to do what you promised it would do. And as we get involved with being an asset manager, portfolio management can take up a lot of our time. What we see, the more effective way to go, I think, is being an asset gatherer. An asset gatherer is more focused on financial planning. They're more focused on client relationships. That's where a large percentage of their time is spent. And what they do, just like on the insurance side, you seek out insurance companies that are going to meet the needs of your clients. They seek out asset managers that align with their client goals. So that first question, do you want to be an asset manager or an asset gatherer, is important. I think it's something you need to commit to. We talk a lot about the idea of, we just had the Super Bowl a couple of weeks ago. And I always point to Andy Reid because I followed his career. Andy Reid is the head coach. And Andy Reid probably played offensive line at some point in his life. He's not expected to coach the safeties. He hires an expert to coach the safeties. And he's got a running backs coach and a wide receiver coach. Part of being a head coach is recognizing where your gifts lie and assigning other coaches or asset managers or insurance companies, assigning them the job that they're good at. And then as the head coach, what you do is you make sure they execute. And that's what an asset gatherer does. The second question.
So Kevin, just on that real quick, one of the things that I always try to focus an advisor on, if you can go back just that one slide, is when you're making that determination, if you're debating about, do I want to be an asset manager, you have to look at things from a risk reward standpoint. There's a definitely, if you're the asset manager, if you're the portfolio manager, you're making those investment decisions, you're not managing the relationship and selecting other asset managers to do that job for you. You have a much higher risk of replacement because your life is going to be based on that performance as you've got on the list there. And it's harder to grow because you're spending so much time doing this that the only way you can really grow your block is by performance, by having the values of these accounts growing along with it, versus the asset gatherer. They have much lower risk of replacement. They tend to be paid more. They tend to have higher pay because it's easier to grow, because they can keep adding relationships, and they have economies of scale because they're just dropping advisor or clientele into their advisory models that they've created using other asset managers. So it doesn't bog them down as their practice grows. And I think that's a really important distinction when you have to decide between which side of that fence do you want to live on.
Yeah. Question number 2 is an important one as well, and it's something a lot of us have struggled with over time. Should I be an IAR under a corporate RIA, or should I start my own RIA? And there's a couple of things here that are pretty important, but it really comes down to, in my opinion, 2 things: return on investment or return on your time. Because one may cost you a little more in terms of money, but the other will cost you an awful lot in terms of effort. And so, as an IAR under a corporate RIA, you can see it on your screen. Usually what happens is, in exchange for the operations and compliance support, you receive a small haircut on whatever business you're doing on the AUM side. But also, as a part of that haircut, you're able to leverage technology and platforms that the corporate RIA has, the relationships that RIA has built. And the other big one is, of course, in the world we live in, having that support of in the audit world. The regulatory audits are typically handled by the corporate RIA because they've got the manpower and the expertise behind them. Now, on the standalone RIA side, some folks like to go that route as well. There you're required to manage all your operations and compliance functions. You've got the technology and the due diligence that becomes your responsibility. You've got to figure out which software systems work best for me. Where do I go? And there's a lot of work involved there. And then finally, of course, the responsibility of dealing with regulatory audits is either yours, or you might assign it to a third party, an attorney firm somewhere. And typically that can work, but they don't have the relationship with you that a corporate RIA may. And so the big question for number 2 is, how do you want to work in this AUM space?
And I will just interject there that to become SEC registered as an RIA, you need to have $100 million of assets under management or greater. So anything beneath that, you become state registered. So that's kind of a good indicator of when they believe that you have enough infrastructure in place and enough scale in place to really be a standalone RIA. So now many people will bite it off at a lower level, as Kevin pointed out, but just keep in mind, if you go to the standalone RIA structure, now it is a little bit about of a staffing issue. So for example, you don't want the individual who's bringing on the new client, who's making the sale, to also be the one who deemed that sale suitable. You end up having a very difficult time managing that conflict of interest. So you have to have enough people involved on a standalone RIA to appropriately handle those compliance components, versus an IAR where you're essentially you're handing that off to a third party to deal with that piece, so that you can focus on the relationships and the customers and running the practice. But again, it's a differentiation that you have to be able to make in your practice as to what's the best route for you.
Right. And the third question, I think, really takes a lot of time as well. It's one of those things that we had it on an earlier screen, where you start with the end in mind. What does my ideal business model look like? And just some of the main questions, going forward, what will your revenue mix be between AUM and transactional? If you're looking at your ideal into the future, what do you want this mix to be? And then, of course, how will you market your business? Do you have a plan in place to ensure you're operating in a compliant manner? I think that's always important, of course, in the industry we're in. what technology and business building platforms will you use? How is your brand strategy? Who's my ideal client? All of these things, there's a reason you're looking at this, because there's a lot of decisions to make. And so, as we look at going into this blueprint, these are all things you've got to decide really before you determine, is this an area that I want to expand my business?
And so we employ an entire team of people. We call them our business development consultants, and they're there to help you kind of figure out, how do you want to stair step into that? So if you're not doing a lot of AUM business right now, it's not something you're probably going to jump into cold turkey and just quit doing commissionable or transactional. And we would advise heavily against that. But there are strategies you can employ to kind of stage or stair step your way into this. And it really doesn't matter where you're at. If anywhere you are in that equation, if you're looking to develop more AUM, there's ways to stair step in. And the good news is you can generally do it on the business you're not currently managing or bringing into your practice to begin with. The stuff you're leaving on the table, this is going to give you an opportunity to go back and collect 100% of those assets, which we'll touch on towards the end as well with some of the tools that are available for you.
So once we've kind of discussed those three questions, now we can get into the factors that have to fall into place really for exponential growth. The three areas of concern, and we kind of mentioned them already, but operations and compliance, business development, and technology. And so in terms of operations and compliance, there's a couple hurdles here. I mean, really, once you've decided on securities and AUM, once you've decided they're going to be important, then you have to get serious about what you're going to offer and why. Asset manager due diligence. There are hundreds of thousands of asset managers out there. And many of them have, shiny objects and a great story. Others are good at what they do, but they're not as polished. And it takes a lot of work on your own to do that due diligence for the asset managers. And of course, business processing becomes important, because it's one thing to find a manager you like. The next thing you've got to figure out, along with their regulatory filings and what you have to do to use the manager, is where is the manager custodian? What paperwork do I need? Business processing, how much of a bog does it become to use money managers you like to use? And what happens a lot of times in that world is, does ease of doing business override the appropriateness of the solution? Can I jam everybody into this one set of money manager strategies just because I know their paperwork? And one of the other things, of course, we always take into consideration is fees and expenses. Where is there a conflict of interest? If I use money manager A, do they allow me to charge more versus money manager B, and versus from custodian to custodian? These are all, in terms of operations and being compliant, things you have to consider. The goal here is really ease of doing business. How do I make this simple? And so let's take a look at how other people are doing it. The idea, the solution is a turnkey asset management program. And these are programs, a TAMP is a program that, not just very few people are using. It's not a new thing anymore. What this chart really shows you is that everybody is using TAMPs, and RIAs are using them more than others. But getting your arms around a TAMP platform gives you the chance really for growth, for a one-stop shop, if you will.
So this has really become like what I call the $2 trillion solution. As you'll notice, what this bar chart is kind of showing you is that the industry has embraced the idea of a TAMP, and it has to do with the way it streamlines your business. As we kind of touched on, and Kevin will dive deeper into as we move forward, is you've got dozens of different asset managers with hundreds, if not thousands, of different models at your fingertips in a single account, on a single platform. And that's the value of the TAMP. And as you can see, whether you're talking about RIAs all the way into banks, law firms, family offices, everyone is embracing how valuable the TAMP is in terms of running their operation.
And so one of the things to think about is, well, that's fine. Everybody's using a TAMP platform, but are my clients big enough to use a TAMP? Is it appropriate for everyone? And really what a TAMP is, it's a unified managed account. It's a UMA. Maybe you've heard that term before. There's SMAs, a separately managed account. Well, a UMA is an account that allows you to hold separate sleeves inside of one account. And what this page really shows you is that for most of our ideal clients, anyone with a net worth of $250,000 or more, a UMA is a great solution. It gives you the chance in one place to meet the needs of your clients wherever they are. And so I want to illustrate that a little more, give you a better idea of what that looks like. And so, there's a bunch of different TAMPs out there. There's TAMPs that have thousands of solutions. There's other TAMPs that have only the specific company's offerings on the platform. There's a bunch of different types of things. I want to show you what the structure of a TAMP is and how it can help you in terms of client solutions. And so in finding the right TAMP, a TAMP is not the solution. The right TAMP is the solution. And the TAMP that you're looking for is one that performs all of these vital functions for you. Again, we're talking about scaling your business. We're talking about ease of use. And if you can find a TAMP that has already done the manager due diligence, rather than just dump thousands of managers on the platform, they've taken the time to be exclusive, to build relationships with the managers that are on their platform, to verify that they do what they say they're going to do, to have a place where client access is easy and friendly, where a client can check their accounts and understand what they're looking at when they see them. A TAMP that handles the billing and the reporting. I think that's important. That, of course, handles the statements as well. The other thing I think that's important about the right TAMP is a TAMP that the administrators of the TAMP are doing ongoing analysis on the managers that are on the TAMP. Is the manager continuing to do what they claim to do? Are the strategies that they employ still appropriate? Should they still be on the platform? I think that's important. And also, in terms of ease of use, does the platform offer you some sort of really turnkey proposal system that's going to meet client needs? One of the things when you think about long-term money, when you think about investing, the term that gets thrown around a lot is diversification. And what a good TAMP does is offer something that, it's a fancy term, but I really think it's important. It offers something called multi-dimensional diversification. What you see here is in one place, one custodian, one account, one set of paperwork, you have access to give your clients, depending on their needs and their dollar amount and everything else, you can get them. Manager one might be an active stock trader. They may have a model that invests in stocks, that trades monthly, that looks at it weekly. Well, you can get your clients into that account. And alongside of that, manager two might be a passive manager, where they look at an account, they look at their investments once a year, they rebalance, and they will be passive and let the money grow over the course of a year. Where manager three might use ETFs, manager four may be using mutual funds. Manager five might be a fixed income manager, someone that works in the bond world. And so you can offer all of these strategies inside of one account. It's a game changer. It's how you experience exponential growth. And so I think the other thing the right turnkey asset management program has to do is allow you flexibility. For a lot of us out there, we're busy. We don't want to do the research on 25 different managers. We don't want to look at hundreds of strategies. Well, for instance, our platform on the exchange platform, there's a couple of different ways that you can use it. It offers that flexibility. First of all, I kind of describe it, in the old days when we had restaurants with buffets. If you want to, you can go up to the buffet and you can fill that plate any way you want. You can take your client's account and you can look at all the different money managers and choose different strategies from different managers. If you don't want to do that, well, we also have a pre-built menu. We also have strategies that are designed for the conservative to aggressive clients that are set and monitored on your behalf, whether it's quarterly or annually, to meet the needs of your clients. So you can come and order off that menu. And maybe you are, to a certain extent, an asset manager. Maybe you have a strategy that you really like that works really well, that's unique. Well, we actually have the ability on our TAMP platform for you to manage a sleeve of a client's account next to the other managers. And I'm going over this quickly. There, as there more questions come up, Matt will give you an opportunity to get in touch with us to speak to that. But flexibility is important. Having the ability to do a bunch of different things inside of one place is important. But it's also important to understand, I think, that the right TAMP is not a robo solution. It's not a place where you just go and you have no support. If you've committed to being that head coach, that financial coach, it's important that you have someone to help you navigate. One of the things that I think in our business, it's important to have that sounding board, have that person available to run ideas by, to help with client solutions. And we have that, of course, too, on our platform. And so in terms of technology, one of the things that we need to do, because we're as generally as advisors, we're good at a bunch of things, but we're not good at everything. And so we need to be able to leverage technology to assist with client acquisition. And so I mentioned earlier, some of the basics, a platform that helps us and takes care of the fee billing, a trading platform where we don't have to go in and push buttons. But it's also nice if that platform could have a risk assessment tool, even a portfolio analysis tool, something that will analyze their current portfolio and maybe compare it to their existing portfolio versus what we propose. A good TAMP platform, I think, offers these solutions for you. And so let me show you what I mean. What we have available to us on our platform is we've got a risk assessment profile tool that allows us to have the conversation with the client. And, it works a couple of different ways, but very basically what you see here is the client can fill out a questionnaire. We can verify that they are in fact in the right risk band and assign them a risk score. And what that risk score will do is it will coincide with the strategies on the platform. But what's really neat is that if we choose to, we can also analyze their existing portfolio. And so what you see on your screen here is this risk tolerance band. Sorry, I'm pointing at your screen. Is this risk tolerance band where we see where the client fits. That gray area is where they fit. And then what we can do is the gray one, of course, is their current portfolio. It's a little out of whack. And we can show them a solution that puts them back into their risk profile. One of the other things that I think is a value is that the other thing you can do is, if you'd like to, you're able to name the portfolios that you create. And so, as I mentioned going up to the buffet and picking out different strategies. Well, actually, what you can do is once you've found strategies, you can actually give them a name. So when you talk with a client, it's easy to explain, I've got this pre-built model for you, and this is what it can look like. And it is unique. It does provide value, and depending on your brand, I think it can help with your brand as well.
Kevin, this is actually one of my favorite features because you can create composite models that are customized to you and your practice. So if you want to have, starting at conservative and working your way up, maybe 5 steps up to aggressive, you can then name those and brand those to your practice or to your approach to planning, and it kind of puts this really nice wrapper around the asset managers you're using to represent the portfolio, but it kind of makes that portfolio understandable and it kind of brings it to life in a tangible way.
Yeah, and so I wanted to switch slides so you could get an idea of what Mike was talking about. So, this is if your company was Financial Concepts, you've got the ability to pick the strategies and set them up inside of the system. So it's a one touch for you to go grab that proposal. So you can see we've got an aggressive, a conservative, and a moderate on the screen, and you're able to go in and set those up, in whichever way you think is appropriate. And like Mike said, it's a wrapper to what the money managers may be. And so what I've done, just in preparation for this is I put together a model of 4 different money managers. And together, those 4 money managers are the Financial Concepts aggressive model. Now, what's really neat is you've been able to brand these at point of sale, but you're also, again, even as you've branded this model, you're always able to review the components of the model. And if necessary, just like a head coach might replace a position coach, you're able to replace those things, even though they're inside of the model that you've created. I think it's a very nice point of sale piece. And with this tool, the other thing that it has done based on these 4 models, what we're able to do is pull the data from Morningstar, and we're able to combine that data of the 4 models to get you an idea of what past performance may have been. But we're also able to get you the risk metrics. We're able to be as detailed as you feel your client needs you to be to present a solution on the money management side. And so, it was a quick overview. I wanted to show you a high level of what the right TAMP can do. Obviously, I want to get you, first of all, back to Mike. I want to switch gears and have him talk about how this can integrate with fixed income. And like I said, at the end, Matt will talk with you about how to learn more about all of this.
So with a little bit of the remaining time, I mentioned early on that we do in fact embrace the transactional revenue, the commissionable revenue, in addition to the recurring and the asset under management revenue. And we've taught many advisors how to marry those things together appropriately in a portfolio. And this is just a quick example that shows you kind of how these things really fit together hand in glove. So this is just interest rates, the Fed fund rate going back to the early 1980s through today. And obviously you can see there is a general downtrend of interest rates that has taken place over that period of time. And for those of you who are well versed in your bonds, you understand that bonds have a teeter-tottering effect. So as interest rates are declining, if we go back for just a moment there, as interest rates are declining as they've been doing for the last 30 years, that means the underlying value of the bond is going up. And that's been really good for your bond investments. Now, the opposite is also true. If interest rates start going up, that means the underlying value of the bond is going to go down. And given where we are, essentially at 0 interest rates on the Feds, people believe that rates are going to have to go up. This is a really interesting piece because it was put together by Forbes, and they just created a little cheat sheet chart that shows you what will happen to bonds as interest rates increase. So if you have a bond across that top blue bar that's, let's say, has a 7-year remaining duration on it, and interest rates were to go up by 3%, what they're telling you on this chart is that the underlying value of that bond is going to decline by 21%. It's just a cross matrix, right? I go over to the 7 and then I come down to the plus 3% and I've got a minus 21. So it shows you just the volatility that will be there as interest rates come up and how that can affect bonds. And so what we have done is we've helped a lot of advisors start to move portfolio business, if they were doing a lot of bond portfolio, to start understanding how a lot of the fixed index annuities work and what the value of that is. In fact, Roger Ibbotson, who's a very well-known name in the investment world, kind of infamous, if you will, did a really interesting study. And in fact, I think Matt is going to join us here at the end and make this piece available to you. There's a whole study that goes with this. But if you look to the far right, FIA, that's the fixed indexed annuity. what he's basically illustrated through his study is that the fixed index annuity is a more stable, long-term safety or conservative play inside of a portfolio than are bonds. And so that's a perfect match, because if you go to the next piece, what you'll see is what we're doing with the fixed index annuities is we're buying time inside of a portfolio. So let's say you're using an annuity to create an income stream for the next 5, 10, or 15 years. That's now allowing you to take the rest of the portfolio and invest it appropriately in equities. All the stuff that Kevin was just showing us, some of the tools of how to do that. And if you put time on your side, it's pretty much impossible not to come out looking like a superstar as an advisor, because what this chart is showing you here is that if you give the market its time, it's going back historically on the S&P 500 here, if you give it at least 5 years, there's an 81% success rate for a positive return. If you give the market at least 10 years, there's an 89% success rate for a positive return. And right on up for 15 years and 20 years, at 20 years, there is a 100% success rate, historically speaking, for a positive return on the market. So the value of marrying together the annuities with the equity portfolio is to, in fact, buy time. And we actually have a tool designed specifically for that. We call it the Asset Cycle Portfolio System. And it is a financial planning tool that is truly so simple, it's profound. And it creates a cyclical effect for the investor, showing them how to use annuities in conjunction with their equity investments and all of their assets under management, so that you can literally create and recreate the retirement income stream, recreate the paycheck through retirement, if you will, off of their assets, but do so in a way that really makes sense. Every account has a job description, and the client actually understands what each piece is for, and it becomes a bulletproof way to introduce financial planning and to secure financial planning to gather 100% of the assets rather than just a transaction or two. And so with that being said, I know that Kevin has a few wrap-up things, but also I know Matt Eilers is going to make this available for you as well and tell you how to learn more about the Asset Cycle Portfolio System, which could really be super valuable to your practice.
And yeah, just a few key takeaways that I wanted to leave with you. The biggest thing to position your business to do what's best for your clients, of course, is key. And best is not about performance, certainly not about short-term performance. And when you're an asset gatherer, that positioning is so important. It's so key to be able to talk about that with a client, because a client that is won based on investment performance is also going to be lost based on investment performance. And also, by the way, a client that is won based on fees is going to be lost on fees as well, because there's always someone cheaper. Naming strategies, processes, it can create tangibility and value. It's one of the things that we found there's so much value in, is when you can name a strategy, it becomes unique. But it really boils down to having a process. Once you have a process that you can articulate easily, it makes all the difference. Thanks for listening. Thanks for your time. I want to pass it back to you, Matt.
Great. Thanks, Kevin. Thank you, Mike. Everybody, want to be super respectful of your time. We're right at 44 minutes, so we're going to begin to wrap this up. And I know at this stage in the conversation, you probably have a lot of questions. We covered a lot today. We talked a lot about, TAMPs. We talked about, using annuities as a bond replacement. Talked about using a tool like Asset Cycle to gather all of the assets rather than just focusing on a chunk. So want to let you know how you can get in touch with us and what that process looks like. I really believe in transparency. Want to let you know that if you want to have a discussion after this webinar, we're happy to. And this is what our process looks like. We'd love to have a chat. We'd love to have a fit call with you. And essentially all that is, ladies and gentlemen, is an exploratory discussion where we can figure out if it makes sense to talk again. You're going to have a chance to ask us questions. We're going to have a chance to ask you questions, get to know you a little bit, get to understand your practice. We can talk about things like the asset cycle. We can answer questions about the TAMP. We can talk about your business. And if we believe that it makes sense to continue the discussion and dive a little bit deeper, the next step in our process is what we call the gap analysis. And what we would invite advisors to do is participate with us in that conversation. And really what it is it's a way for us to showcase our consultative approach to how we partner with and work with financial advisors just like you. And there's no strings attached for this. There's no cost for this. You don't have to join our firm to do any of this. We just would like to have a conversation. It allows us to dive deeper and figure out if what you're looking to accomplish in your business is a good match for any of our expertise. And typically what we're able to identify in the gap analysis is just some small tweaks. We believe that small hinges can swing big doors. And we can help identify those for you and have a conversation about it. And for many that go through this process with us, they realize that, again, they want to dive a bit deeper. And we have a solution for that. That is our discovery experience. That is for someone that really wants to look under the hood, kick the tires at USA Financial, really understand how their business could fit in to our infrastructure and in a partnership with us. And we have a process that we take you through. And we actually do all that virtually right now. We've been doing it for about the past year in this format. So we've got it pretty dialed in where you can do that comfortably from your office with your staff. And leaving a process like that, you will walk out of there with a custom marketing plan and what we call a value gap blueprint. And that's essentially a financial plan for your practice. And we arm advisors that go through that process with us with those items. And they can take those with them and do what they want, whether or not they ever decide to partner with us. So just want to let you know, again, in the spirit of transparency, this is what it looks like. So to get into a conversation with us, to answer questions about anything that we've talked about today, or even on last month's webinar, there's no big sales pitch that you're walking into. It's a pretty easy process. So Kevin, if you could jump to the next screen, one of the things that you will really be able to uncover as we get into a conversation together is we'd like to share with you and have some discussion about, the advisors that we do partner with that did experience growth like this in 2020 that you're seeing, some of the things that they were doing, how this worked in their business to help you translate how it might work in your business, in your practice. And when it comes down to it, a couple of things you see highlighted up on this slide. It's the same slide we showed earlier, but just draw your attention. The advisors that experienced this success in such a tumultuous year, they did recognize the opportunity. They embraced things like tools and systems and technology and support and new items that needed to be created. But by doing this, they became more introducible than ever. We talked about that last month. Our advisors experienced this growth. They were getting more introductions than they ever have in their career. And again, the other common denominator, which led to today's topic, was, it was recurring revenue also that was driving and keeping them afloat during the pandemic as they were still gathering some transactional alongside it. And we know, for advisors that are out there that, their 2020 didn't look like this. And we know that's the case for many. It wasn't because they weren't trying. Golly, I think everyone tried more than they ever have last year. But what we have really identified is that they weren't getting the support that they deserved from those that they partner with. And Kevin, if you could jump to the next slide for me, you've seen a bit about our structure and how we support advisors through all the different entities that we have. And at this point in the conversation, advisors are usually asking, are you a broker dealer? Are you an FMO? Are you a RIA? The answer is yes. And Mike talked about it earlier. We are all of those things. But the point isn't that we have all these companies under the roof. The point is what having all of these under the roof does for the advisor and what it does for their business and how it can fuel enterprise growth, because advisors we partner with actually grow their business. It was evidenced by some of the numbers that you saw just from last year. And you're probably thinking at this point, well, golly, with a firm like this, with all of these different entities, there's probably thousands of advisors that they've affiliated with. How the heck could I fit in, or why does it make sense for me to learn a little bit more? Kevin, if you could jump forward, if you take a look at this line here, this represents, going back to the birth of USA, our growth trajectory. And this is revenue, right? Our revenue at USA Financial is a direct reflection of the advisors that we partner with. This blue line is their blue line, essentially. And Kevin, if you could click forward, what I want to illustrate here is, we don't have thousands of advisors that we affiliate with, and it's completely by design. You look back, there was a pivotal moment in the history of USA Financial back in 2004, where there was a time when we affiliated with thousands, and there was an important decision that was made. And that decision was all about fit and alignment, and about us making a commitment to those that we knew that we could partner with, that aligned with all of the stuff that we could do, that we could impact the most. And we ended up essentially realigning our business with about 200 or so offices at that point. And you can see kind of the rest is history. And currently, as we sit today, we work with about 250 advisor offices across the country. And you can see what the blue line has looked like, the advisor's blue line, ever since. So we don't have thousands of advisors here. We've taken the approach of, rather than going a mile wide and then only an inch deep into how we can help them grow their practice, we wanted to stay an inch wide, so that all the different tools and systems and processes and technology, so we can take that a mile deep into the advisor's practice. So we'd love to talk with you more about that. And if Kevin, if you could jump ahead, where I'll leave us, and we're going to begin to wrap up, because I know we're about 5 minutes over, is two things that we want to arm you with as a thank you. Thank you so much for taking the time to sit with us today. We want to first and foremost get in your hands that white paper from Zebra Capital. That's the Ibbotson study. This is probably one of the best pieces of research I've seen in a long time. And there's some really, really good takeaways. You need to take the time to go through this. We're going to get that in your hands. On top of that is Asset Cycle. We talked about, this is the tool that allows advisors, so many of those advisors that you saw that grew their business, it was because of the fact that they were gathering both, AUM and transactional revenue, and they had a good base of that AUM. This is the tool that they use. This is how they are able to gather 100% of the assets they're in front of, rather than just a smidgen of it. So we would love to get in your hands a sample of what that deliverable looks like. And even better than that, we'd love to schedule a demo with you so that one of our senior business development consultants could walk you through what it looks like. Again, this could be part of a fit call. We'd love to share with you the sales story, help you understand how at the point of sale this is being positioned. So our promise to you is that we are going to be in touch. We're going to reach out. We have your information. Most of you have been in contact with one of our senior biz dev consultants already. So look for them to be reaching out probably today or tomorrow with this info, so we can get it in your hands. And for those of you that want to take the conversation beyond those pieces to an exploratory fit call, we're happy to get that scheduled as well. So with that, I'd like to go ahead and wrap things up here. What I'd like to do real quick is give you all a save the date. I want to let you know that in a month, it's actually Thursday, March 25th at noon Eastern, we're going to have our next Advisor Advancement Mastermind series. That session is going to be all about sales and appointment process, and some of the best practices and some of the best things that our top advisors are doing to set themselves apart. So you don't want to miss that. Our team will be in touch with that information on how you can get registered. But Mike, Kevin, thank you so much for the time today. We really appreciate it. And most of all, to the advisors that you took the time away from your business to work on the business a little bit over lunch or in the morning hours, for those of you on the West Coast. Thank you so much. Your time, we don't take it for granted. So we hope that you got some good things out of this session. We look forward to our follow-up with you in these next couple of days, and we look forward to seeing you again next month for the next session. Make it a great day, and thanks again.